Welcome to Fun with Annuities with your host, me, Stan the Annuity Man, America's annuity agent. Can annuities be fun? Can contractual guarantees be fun? Absolutely they can. Find out the brutal facts about annuities with no sales pitches or high-pressure nonsense. Just the brutal and factual annuity truth, which is all you need to hear. Let's have some fun with annuities, and let's have that fun start right now. Hi, I'm Stan the Annuity Man, America's annuity agent, licensed in all 50 states, and I'm welcoming you to Fun with Annuities, the #1 annuity podcast on the planet. Yes, Fun with Annuities. Can annuities be fun? Yeah, they can. I mean, if you are structuring your lifestyle for lifetime income or principal protection, if you want to put in some legacy or long-term care, annuities do have their contractual place. So, yeah, it's called Fun with Annuities, and I am looking forward to talking about the topic today, which is which type of annuity is right for you. When it comes to retirement annuities, and I guess you can call every type a retirement annuity because there's many types of annuities, which one is right for you? Which one is best for you? I get this question all the time. You know, I get the guy that comes, "Hey Stan, what's the best annuity right now? What's the best one?" I don't know that, Chester, until you answer a few questions for me. So before we get into that, I'm going to go into the details of all products and tell you some stories about what people have done, and maybe they'll apply to you. Let's go through a couple of things. Number one, this podcast is on all major platforms. If you're listening to me on things like Spotify or whatever, that's fantastic. But you can also see the video version of this as well, this podcast, on the Fun with Annuities YouTube channel. I also have another YouTube channel called Stan the Annuity Man, which is all about educational videos, etc. But if you want the full version of the podcast with me, yours truly, top agent in the country, Stan the Annuity Man, then you can watch it and see me get animated and see what's happening in the will do, not might do studios, which is what you're seeing around me. For the people listening on podcasts, I have a studio that this is coming out of, and the camera I appropriately call the Annuity Fun Cam. So, annuities can be fun, and this is Fun with Annuities. So the other thing that I always say when it comes to the Fun with Annuities podcast is, our tagline is living the reality, not the dream. And what that really means in the annuity world is living the contractual reality, not some sales pitch dream that some agent or advisor is telling you about this too good to be true annuity. Spoiler alert, I mean, every single time without exception, annuities, if it's pitched as too good to be true, it is too good to be true. These are contracts. Every single type has limitations and benefits. Good and bad, and we're going to go over everything. If you deal with me, and you will, if you're going to work with annuities with the Annuity Man, it's going to be with me, Stan the Annuity Man, one-on-one. We're going to determine, when it comes to retirement annuities, which one is best for you. We might come to the conclusion that no annuity is best for you, and I'm very open to doing that because the truth is the truth. As my grandfather said in North Carolina a long time ago, he used to say, Stan, if you tell the truth, you don't have to remember anything. And I think that's true. That's kind of the approach we take at theannuityman.com and the whole business model. Yes, we're licensed in all 50 states, but people always say, well, annuities are, no one buys an annuity. Everyone just, they're sold. No, that's not true. At our site, we pride ourselves in the fact that you come to our site, you will buy an annuity if it's appropriate for you, but you will never be sold one. You'll never have one high pressure jammed down your throat, and I promise that. So let's kind of jump in a little bit, to the topic. Before we do that, one last thing: my site, theannuityman.com. You can get my books. We'll ship them to you for free. You can schedule a call with me. You can run quotes on your own on our proprietary annuity calculators, which is really cool. You don't have to talk to me. You can just run the quote. And there's live MIGA feeds, etc. In other words, you can do it all at the site. You can watch the videos and podcast replays and all that stuff. So with that being said, the common question is which one's the best for me? Which annuity, Stan, is the best for me? I'm at the retirement age, with so many people. I mean, the stats are just unbelievable. 10,000 people per day turn age 65, which is kind of that retirement zone. Every single day, they turn 65, which is a demographic tidal wave of people that are kind of transitioning from the market growth, chasing the next Tesla or the next Apple or the next, best ETF or whatever. And they're transitioning from that to kind of the guaranteed side. And that's what I do, contractual guarantees only. My saying is you own an annuity for what it will do, not what it might do. This is the will do, not might do studios that I'm filming in and doing these podcast recordings in as well. You buy them for the contractual guarantees. You never buy the hypothetical, theoretical, projected, back-tested, hopeful agent return scenario. Now, a little background on annuities, and if you do know this, hang in there with me. If you don't, it's kind of interesting. Annuities started in the Roman times. Back in the day, the word annua, A-N-N-U-A, I think it means annual payment in Latin. Didn't take Latin, but that's what my director of operations told me. That's what it means. And the dutiful Roman soldiers for the empire were given these lifetime income payments for them and their families because they had laid it on the line for the empire. That's where annuities started, and they've been sold in this country, the United States, for a couple hundred years plus. Most of the original ones were these single premium immediate annuities, the kind the Romans were doing back in the day for the Roman soldiers. Nothing's really changed because it's a lifetime income guarantee, and that lifetime income guarantee is primarily based on your life expectancy at the time you take the payments plus interest rates, with interest rates playing a secondary role. So, for the people out there that say, well, I hate all annuities, Stan, I saw this ad the other day and it said, hate all annuities, I'd rather kill myself than buy an annuity. Spoiler alert, you already own one. I just did a podcast on this and got a lot of blowback because people are like, I don't own an annuity. Yeah, you do. It's called Social Security. It's the best inflation annuity on the planet. In fact, I just read an article today, to back up the best inflation annuity on the planet mantra. The 2021 increase is going to be like 1.2% or something like that. That's just the government saying, you know what, we're just going to increase the payment. That's fantastic. When you do that with a commercial annuity and you put an inflation increase, the annuity company does not give that away. They just lower that payment to make up for that increase. So you already own an annuity. If you have a pension with a company, that's an annuity. So from a retirement standpoint, and we're talking about retirement annuities, when you get to retirement or you're thinking about retirement or you're planning for retirement, one of the things that you always should have in your mind is, what's my income floor? What's the income floor? It's that guaranteed amount of monthly income that's going to hit your account regardless of who's in office, regardless of geopolitics, regardless of the markets. These are contractual guarantees. Social Security, pension, let's throw in rental income or really good dividend income from blue chip type stocks, and then you have annuities that can also be contractually guaranteed. And by the way, just as a side note, and just if you really want to stump everybody at the next cocktail party, annuities are the only product on the planet that guarantee a lifetime income stream. It's a monopoly that only annuities have, and that only annuities offer. You would think that the annuity industry would promote that, but for whatever reason, they don't. But that's a fact. So when we talk about retirement annuities and what's the best type of annuity for you, a lot of times it comes down to income, because lifetime income is the benefit proposition that only annuities can offer. And most people, there's not many people in the world, and I do have a bunch of clients that say, well, I don't need any income. Okay, great, but most people do. Most people are like, you know what? A little bit more income might be good. A little bit more guaranteed income might be good. A guaranteed income stream for my spouse or wife or partner might be good when I pass, knowing that they're taken care of. Remember, annuities are transfer of risk products. They're contracts. So the question is, when you say what retirement annuity is best for you, then I need to know, what are you trying to solve for? What are your goals? I've really stripped this whole thing down into two questions. If you heard it before, it's okay for me to be repetitive because this is important. And this comes down to all annuity types. Here's the two questions you have to ask and answer. Number one, what do you want the money to contractually do? And number two, when do you want those contractual guarantees to start? That's it. Let me do them again. What do you want the money to contractually do? When do you want those contractual guarantees to start? From those two answers I hear from you, then I can choose the type of annuity that will provide the highest contractual guarantee on the planet. And I go shop all carriers using your quote parameters to find the highest contractual guarantee for your specific situation. The other thing that I've come up with is an acronym called PILL. Once again, I'm a little repetitive with all this on my stuff because this is how simple it can be. Okay, all the bad chicken dinner seminars and all the stuff you read, and all the complication unnecessarily is being promoted out there. It comes down to the two questions, and then my acronym called PILL. P stands for principal protection. I stands for income for life. L stands for legacy, leaving money to your beneficiaries. And the other L stands for like long-term care, confinement care, that type of coverage, nursing home care coverage. Let's do it again. Principal protection, income for life, legacy, long-term care, confinement care. This is important. If you do not need to contractually solve for one of those four things, principal protection, income for life, legacy, long-term care, confinement care, you do not need an annuity. It's that simple. It really is. So if you come to me and you say, you know what, I want market growth, Stan. I went to this bad chicken dinner seminar and this guy said I can get market upside with no downside. I can get full market participation, protect the principal. First of all, that's garbage. That's a half-truth pitch of an indexed annuity. Indexed annuities are fine products, but they're CD products. They do protect your principal. But since they were introduced in 1995, they've produced CD-type returns, which is great because that's what they were designed to do, and that's what they do. Once again, if it sounds too good to be true, it is every single time. But let's go back to the PILL thing. If you said, you know what, I don't really need to solve for principal protection, income for life, legacy, and long-term care. Guess what the best type of annuity is for you? No annuity at all. And I'm okay to say that. You should be okay for me to say that. It's called the truth. It's brutal. It's brutal annuity truth is what it all comes down to. But if you said to me, hey, I do need one of those four, then I can start quoting, looking at the highest contractual guarantees. So let's do this. Let's go over each specific product type, the big ones, and let's talk about how they fit as a retirement annuity. Because we're talking about retirement annuities. The question is, what type is best for you? Okay, not the agent, you. Okay, so let's talk about single premium immediate annuities, which were the ones I talked about in the Roman times, or the original ones. From a retirement annuity standpoint, this is the granddaddy of all for lifetime income. If you need lifetime income to start within 30 days from the policy being issued up to a year, then your only choice is a single premium immediate annuity. It's going to provide the highest contractual guarantee. You can customize the structure. You can have it your life, joint life with a spouse, joint life with someone else. You can make sure that 100% of any unused money goes to the beneficiaries. That's one of the biggest misconceptions I run across is, hey, Stan, I'd never buy an annuity because when I die, money goes poof. That's one of about 40 ways to structure it. But typically, unless you tell me to structure it that way, we don't do that. We structure so it's a lifetime transfer risk benefit. In other words, if you live to 175, they're going to pay. But we also structure the majority of them so that when you die or when that second spouse dies, if it's joint, 100% of any unused money goes to the beneficiaries, and the evil annuity company doesn't keep a penny. Okay? Now, single premium immediate annuities, that's for income 30 days to a year. If you're going to defer like a year out, a year to 2 years, a year to 3 years, then a single premium immediate annuity becomes a deferred income annuity, a DIA. And deferred income annuities, same structure as single premium immediate annuities, no moving parts, no annual fees, no market attachments, very, very simplistic transfer risk, but it really comes down to when you want the income to start. Same thing applies with qualified longevity annuity contracts. A QLAC, qualified longevity annuity contract, that's what it stands for, is a deferred income annuity that you can use inside of a traditional IRA, not a Roth, a traditional IRA, introduced in 2014 by the Treasury Department and our friends at the IRS. It was a way for them to encourage people to start planning for future income needs, lifetime income, in combination to add to that Social Security payment, which was never put on the planet to be the primary income source, as we know. But the QLAC has been around for a while. In a perfect world, it would be the number one selling annuity on the planet because it solves for a lot of things. But that's another lifetime income product that you can use with your traditional IRA assets, and you can add a spouse or partner for joint life income. And also, there's a lot more to that. I've done podcasts and videos on QLACs. I've written a book on QLACs that I'll send you. But in essence, you can also save money on your required minimum distributions. So once again, you have immediate annuities, deferred income annuities, and QLACs. It really all comes down to when you want the income to start and what account type you're going to use. Since we're talking about account types, all of these annuities that I'm talking about can be used in every single type of account out there. Traditional IRA, Roth IRA, non-IRA, we call it non-qualified, but non-IRA. So it really comes to the contractual guarantees are the same. It really just comes down to when you take money out, how that money is going to be taxed. So those are the first three that are kind of annuitized products, lifetime income products. So let's talk about deferred annuities that don't really involve lifetime income. They don't have to. They're just deferred annuities. And a lot of people say, you know what, Stan, let's talk about the P of the pill, principal protection. I just want to protect the principal. I don't want to lose a penny. I don't want to pay any fees. I want some guaranteed interest. I just want to hit bunt singles, baseball analogy. Well, the first one that you need to look at is a multi-year guarantee annuity, which is a fixed rate annuity. If you like CDs, you'll like multi-year guarantee annuities. We call them MYGAs, M-Y-G-A, that's the acronym. So multi-year guarantee annuities work just like CDs. They pay an annual interest rate for a specific period of time that you choose. Sound familiar? Yeah, it's a CD. The difference is, and this doesn't make MYGAs better than CDs, is that in a non-IRA account, the interest from a MYGA grows tax deferred. Now you have to pay taxes once you take the money out, but that would just, if you said, I've got non-IRA money, and I want to, protect the principal and I don't want to pay taxes on the interest, then MYGAs fit. But CDs are great products, and for shorter term durations like 6-month, 12-month, 18-month, CDs are perfect. No, I do not sell CDs, but they're perfect for that. But once you go like in the 2-3 year out, multi-year guarantee annuities typically outperform from a yield standpoint certificates of deposits. Now, you can combine them, you can ladder them, you can do all those things, but that's a principal protection product, multi-year guarantee annuities. And we have a live feed. If you go to my site at theannuityman.com, you can pull up the best, highest yielding MYGAs in your state of residence 24/7. You can just pop in your state and the duration, and it'll just pop up and show it to you. So the other principal protection product is a fixed index annuity. These are missold and overhyped by agents that don't know better, or maybe they do know better and they shouldn't be doing it. But the point is, these are CD products. When you don't attach a rider to them, there's no annual fees. You get a CD type return attached to an index call option. I'm not going to go into the details of that in the weeds. I've done podcasts and videos and written a book on it. Get my book, watch the podcast. But in essence, index annuities are CD products, regardless of what anyone tells you. And that's okay. Principal protection, no annual fees, it's a good thing. The other type of deferred annuity that I don't sell is a variable annuity, which is in essence mutual funds wrapped with an insurance wrapper. That doesn't mean it's bad. There's typically the variable annuities come with a high fee, but you can also buy variable annuities that are no load, which means no agents involved. You got 100% liquidity day one. I'm just not a fan of variable annuities personally. That's just my opinion. It is what it is. My mantra is you own an annuity for what it will do, not what it might do. And will do is contractual guarantee. So I only sell fixed annuities, meaning that it's contractual. It's never, ever going to go down. The contractual guarantee is what it is. There's no surprises. That's just where I believe annuities should fit and how they should fit. And a lot of that bias from the variable annuity, from my standpoint, comes from the fact that I worked for Dean Witter and then Morgan Stanley and then Payne Weber and then UBS, Union Bank of Switzerland. And because I work for those firms, I understand markets, I understand, true growth type strategies. So in my opinion, annuities aren't growth strategies. They just aren't. There's limitations always to the growth. So I always tell people that if you want market growth, never buy an annuity. If that's the type of retirement annuity you want, don't buy an annuity. Because if you think of the PIL, remember the PIL acronym, Principal Protection, Income for Life, L stands for legacy, and the other L stands for long-term care. There's no G for growth. There's no M for market. So if you want that, then stay in the market, and that's fine. In fact, the best way to use retirement annuities is to use as little amount of money as humanly possible to contractually solve for the goal. I'll give you a story. A guy called up the other day, said, I'm interested in and filling in a gap of the income floor. He had heard my stuff. And I said, okay, we can do it two ways. We can say, okay, here's $200,000. What would that create? Or better yet, I told the guy, I said, hey, what's the gap of the income floor? And he said, well, right now it's like $2,100 a month. Okay, let's go solve for $2,100 a month. So shopping all carriers, doing a reverse engineered quote, punching in the $2,100. We then shopped all carriers to find out who was the best carrier that would guarantee that $2,100 a month for life, the structure that we had put together, which was like a joint life with installment refund. But who would offer that guarantee and back up that guarantee using the least amount of money? Reverse engineering is really a very good way to do annuity planning, because then all of the rest of the money, you keep your powder dry, you keep it in the market. So, you'll be a better investor. Just trust me on this one. You will be a better investor. And I don't do any of the stock stuff anymore. I'm just staying the Annuity Man, fixed annuities. I stay in my lane. I'm an expert. I'm number one out here. That's the reason, because that's my focus. But if you have for instance, if you have your income floor in place, then you're going to be a better investor, because you're not going to worry about that monthly income amount that's coming into your account. And hopefully that makes sense to you. Now, the last strategy I want to talk about, because we talked about immediate annuities, deferred income annuities, qualified longevity annuity contracts, multi-year guarantee annuities, the CDs, fixed index annuities, and variable annuities. The last part is income riders. An income rider is really not an annuity. It's an attachment to a policy, and it's typically attached to either a variable annuity or an indexed annuity currently, and some MIGAs, but mostly indexed and variable annuities. And what an income rider does is it provides a guaranteed future income at a date that you choose to turn that income stream on. It's a separate calculation from what we call the accumulation value of the policy. So, like, for instance, on the indexed annuity, accumulation value would be the index option. On a variable annuity, it'd be the mutual funds or separate accounts, whatever you want to call them. But the income rider is a separate calculation that can be used for future income. Give you an example. If you said, you know what, Stan, I want to protect my principal, but I might need income 9 years from now. Okay, let's look at all fixed index annuities that have income riders and find out which income rider has the highest contractual guaranteed payout 9 years from now. That's how you use an income rider. So once again, going back to the original two questions, what do you want the money to contractually do? When do you want those contractual guarantees to start? Under that example that I just gave you, he wanted principal protection and income, but he wanted the income to start 9 years from now. So again, stripping away all the sales pitch nonsense, let's get down to the two questions and the PIL acronym to find out which annuity type works for you, if an annuity fits at all. So the strategies for what I call retirement annuities. We talked about the PIL. We talk about income now, which is the income now strategy, which is the immediate annuity, single premium immediate annuity. Income later, which is the deferred income annuity, qualified longevity annuity contracts, and the income riders, or maybe it's principal protection. That's the MIGAs and the fixed index annuities. So understand that it just really comes down to shopping for these annuities like they're plane tickets. Annuities are commodities. One of the other things people say, when people call me and say, what's your best retirement annuity? What's your best annuity for retirement, Stan? One of the things you have to understand is annuity quotes are like a gallon of milk. They expire every 7 to 10 days, and they change. And one of the things that sets me apart is that I represent all carriers. So when I go into quote, I don't have any favorite, or I'm not getting, I don't have any skin in the game with any of these carriers other than I represent them and I do the research on their claims paying ability before I recommend them. But the bottom line is you have to look at annuity quotes as commodity quotes. Now, that doesn't mean that you have to make a decision in 7 to 10 days. But it does mean if you want to lock in the quote or the guarantee that either you run on my site yourself or I send to you, if it's a customized quote, then you have to have that application at the carrier within those 7 to 10 days to lock in that quote, if that makes sense. So, one of the things about retirement and people going into retirement and they're going into the world of annuities, it's a scary world because you have a lot of people, in my opinion, that don't have the qualifications to recommend retirement products, so they don't have the background. They're just selling a product. They sell enough of it, they go on a trip to Bora Bora, or they get a gift or something like that. Okay, there's a lot of incentive stuff in the annuity world. What I encourage you to do is never buy, and I said this earlier in the podcast, never buy the hypothetical, theoretical, back-tested, projected, hopeful agent return scenario, unicorns chasing the butterflies, the typical pitch where they're juicing the numbers. Well, if you'd owned it 10 years ago, you'd have made X. Well, 10 years ago, come on. Things were different. Rates were different. Interest rates were different. Annuity products were different. And one of the things that's happening right now in the index annuity world is some of these indices are made up out of midair. And so they'll say, hey, if you owned it 10 years from now, well, heck, it just was created last month. I mean, that doesn't make sense. My point is, don't fall for the sizzle because you're going to own the stake. Don't fall for, the sales pitch dream because you're going to own the contractual reality. That's the reason that the tagline of the Fun with Annuities podcast is living the reality, not the dream. We're living the contractual reality. When you work with me, you're going to be living the contractual reality. And there's no perfect answers to anything out there. And there's no perfect annuity answers, just really bad sales pitches. Just think of it, and when you're thinking about retirement annuities, and we start talking, hopefully you'll set a time with me and we start the conversation. We're talking about transferring risk. We're transferring risk to the carrier to provide either lifetime income or principal protection or a legacy or long-term care, confinement care, that PIL acronym. All right. So I know I've thrown a lot at you on retirement annuities, which one's best. There's no good answer. Just remember the two questions. Remember the PIL acronym. Remember that we can reverse engineer the quote to use as little money as humanly possible. The good news is you can do a lot of this on your own terms. If you're not ready to engage with me and get on the phone with me, that's fine. Go to the site, theannuityman.com, run your quotes, re-listen to the podcast, all that stuff. You can go to my YouTube channels and watch the videos and all those things to get yourself up to speed and educated on if annuities are right for you. And if you say, you know what, they might be, then let's me and you have that conversation so we can find out, from a retirement annuity standpoint, which type is best for you, which type will provide the highest contractual guarantee for you and your family, which type will achieve the contractual goal that you have in mind. And I think that's the key kind of in closing. When it comes to retirement annuities, when it comes to annuities, you're dealing with contracts, okay? So base your decision on that contractual guarantee, and I think you'll be fine. Hey, remember to do this, hit the like buttons on all these podcasts. We try to put these out every single week, so we want you to join us. We are going to have some fun with annuities. Hopefully this has been a little fun as well, and you learned a little bit from Stan the Annuity Man. I mean, I am committed to this, to educating the public on all things annuities, both good and bad, so you make a good decision on your terms and on your time frame. So that's it for this session of Fun with Annuities. Remember, what do we do with Fun with Annuities? We're living the reality, not the dream, and living the contractual reality is a good thing. Thanks for listening to Fun with Annuities. Please hit the subscribe button and make sure to go to my site at theannuityman.com, where you can run your own SPIA, DIA, and QLAC quotes and see a live feed of the best MIGA fixed rates in the country, and even get indexed and income rider quotes as well. You can also sign up for my 6 annuity owner's manual books, and I'll ship them for free and under no obligation. I also encourage you to schedule a one-on-one call with me, Stan the Annuity Man, so we can have a full discussion of your specific situation. It will be the best brutally factual and truthful advice you will ever get, and that's one guarantee you should definitely take advantage of. So join me next time for the #1 annuity podcast on the planet, Fun with Annuities.